This is your technical update from the LMAX Exchange Research and Analytics Desk for Monday, March 21st, 2016. Euro dollar. So the euro has stalled out thus far just shy of the recent 2016 peak from February at 113.77. At this point, setbacks should be well supported while the market holds above last week's low at 110.58, with a higher low sought out ahead of the next upside extension beyond 13.77 and towards next key medium-term resistance around 115. If we do see a break back below 110.58, that would take the pressure off the top side and suggest the market is poised for a more meaningful resumption of the broader downtrend. But until then, while the market holds above 110.58, there is risk for setbacks to be well supported in favor of the next upside extension beyond 113.77. Sterling dollar. So cable has rallied out from recent 7-year lows, with the market extending thus far all the way up to 145.14 ahead of this latest minor pullback. At this point, the broader downtrend remains intact, though we have seen impressive correction, but a break back above 146.68 would be required, that high that we saw going back to the 4th of February, to officially take the immediate pressure off the downside. Until then, there is risk for stalling out and fresh lower top ahead of the next major downside extension. Dollar yen. So dollar yen saw a break of the previous multi-month low last week, with the market extending down to 110.67 ahead of this latest minor bounce and consolidation. At this point, if the market establishes a close below 111, this would open the door for the next major downside extension, potentially towards the 107 to 108 area further down. Back above 115 would now be required to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has been locked in a choppy multi-week, multi-month consolidation, with the market being confined to a range roughly between 107 and 112 further up. At this point, any setback should be very well supported towards 108, with only a break back below 107.15 to compromise the constructive outlook, with eventually a break above 112 seen, opening the door for the next upside extension towards 115 further up. Again, any setback should be very well supported, with the broader recovery structure intact off those lows that we saw, those historic lows in 2015. Aussie dollar. So Aussie has seen a nice rally to fresh 2016 highs in recent trade, though rallies have stalled out, with the market deferring to a period of correction. At this point, though, the break above 73.85 the other week was constructive and does suggest that we could still see additional upside towards next key medium-term resistance at 78.50. Only back below 73.85 would take the immediate pressure off the top side. Dollar CAD. So dollar CAD has extended its declines out from those near 13-year highs in January at 146.90, with the market taking out a key 78.6 fib retracement off of the October low to 2016 high, and now exposing a retest of that October base at 128.32. If the market wants to officially put the pressure back on the top side, it's going to need to take out some recent highs that we saw all the way up at 134.05 to do that. Until then, there is risk for this rally to run out and for the market to once again head lower to 128.32 before it considers the possibility of some form of a serious base. So either we head down to 28.32 or we break back above recent highs at 134.05 about to take the immediate pressure off the downside. Overall, though, with the market running so far so fast and to this correction and this pullback, there is risk at some point, whether it's now or at 128.32, that we do see some form of a meaningful base in favor of a nice correction higher, which could eventually lead to a resumption of the broader uptrend. Kiwi dollar. So Kiwi continues to be very well capped into rallies towards 69 and once again has stalled out ahead of 69 the other week in favor of this latest pullback. Look for the weakness to continue, with the breakback below next key support at 65.46 to strengthen the outlook and expose deeper setbacks towards critical medium-term support at 63.47 further down. Only a close back above 69 would take the pressure off the downside. SPX 500. So the S&P 500 has rallied up just over 2050 in recent trade, but while the market holds below 2050 on a close basis, the risk is for some form of a meaningful medium-term lower top ahead of a bearish resumption and eventually exposing a retest of the recent 1808 multi-month lows seen in February. At this point, only a close back above 2050 would really delay this outlook and put the pressure back on the top side. Gold. So gold has been done a very good job of being very well supported on dips in recent trade, following that breakout that we saw several weeks back above previous resistance now turned support at 1191, 1192. At this point, setback should be very well supported, continue to be well supported on dips, with ultimately a break favored higher back above recent highs that came in around the 1284 area and towards the 2015 peak from January at 1307 further up. Only back below 1191 would compromise this constructive outlook.